The California housing dream is cracking, and in 2025, it's no longer just whispers. From luxury gated communities to high-tech hubs, some of the Golden State's most desirable cities are seeing home values plunge by 15%, 20%, even 30%. Sky-high mortgage rates, bloated prices, surging inventory, and fleeing investors have created a perfect storm. Homes once worth $2 million are sitting stale on the market, slashing prices by hundreds of thousands. In today's video, we're diving into 10 California cities where the housing market is falling apart fast. Number 10. San Ramon. San Ramon, a polished gem in the East Bay, has long been a magnet for high-income professionals drawn to its clean neighborhoods, top-rated schools, and corporate hubs like Chevron and SAP. But in 2025, this suburban dream is facing a harsh economic reality. Home prices here soared during the pandemic, with the median home price peaking at around $1.67 million in 2022. That's a staggering 130% increase from the 2012 average of just $725,000. But now, the cracks are beginning to show, fast. In the past 12 months, home prices in San Ramon have slipped by 7% to 10%, and inventory has more than doubled. In 2023, there were just around 45 active listings per month. Now that number hovers above 110, signaling a buyer's market. Days on market have jumped from 14 days in 2022 to over 48 days in 2025, reflecting declining demand even as mortgage rates remain sticky above 6.5%. Sellers are increasingly slashing prices, with over 30% of listings cutting their asking prices, some by over $100,000. Affordability is a core issue. The median household income in San Ramon is about $155,000, but even with that, the monthly mortgage payment on a $1.5 million home at today's rates exceeds $9,500, including taxes and insurance, far above the safe debt-to-income threshold. For new buyers, the math simply doesn't work anymore. Tech layoffs from nearby hubs like Pleasanton and San Jose are also dragging confidence down. San Ramon's reliance on tech-adjacent income streams means when Silicon Valley sneezes, San Ramon catches a cold. Investors are retreating, and move-up buyers are frozen by interest rate shock. With prices still hovering nearly 86% above long-term value trends and demand evaporating, San Ramon is walking a tightrope. If mortgage rates stay elevated or the economy weakens further, this affluent suburb could easily see a 15 to 20% correction in 2025, turning high-equity dreams into debt-laden nightmares. Number 9. Dana Point. Dana Point is known for its yachts, ocean views, and multi-million-dollar homes. But beneath the glitz of this Orange County coastal enclave lies a housing market that's teetering dangerously on the edge. In 2022, median home prices here hit a dizzying $1.9 million, up from just $1.1 million in 2022-2017, an increase of more than 70% in 5 years. But in 2025, those values are now under pressure as high-end buyers pull back and listings pile up. Over the past year, home prices have already fallen by about 8%, bringing the median closer to $1.75 million. That's still far above sustainable levels. With mortgage rates lingering around 6.75%, the monthly payment on a typical home here can easily reach $11,000 to $12,000, including taxes and insurance, pricing out even many upper-middle-class professionals. Inventory is another red flag. In 2021, Dana Point had roughly 80 to 100 homes on the market at any given time. Today, that number has surged past 200, with many homes sitting for over 60 days. Nearly 40% of listings are now showing price reductions, often in the $100,000 to $250,000 range. For a market that once saw bidding wars, that's a dramatic reversal. Rental income also isn't providing relief. The average rent in Dana Point for a 3-bedroom home is around $5,000 a month, which doesn't cover the mortgage on a new purchase, even with 20% down. Investors are fleeing, and many second homeowners are looking to offload. Worse yet, Insurance costs are rising due to wildfire and coastal erosion risks. Premiums that once ran $2,000 per year are now hitting $6,000 or more. In 2025, Dana Point's luxury bubble is deflating. With homes still overvalued by nearly 100% above long-term trend lines, a further 15 to 25% drop seems not just possible, but probable. Number 8. Tustin. Tustin is the kind of place that flew under the radar for decades, until the housing frenzy of the 2020s turned it into one of Orange County's hottest zip codes. Located between Irvine and Santa Ana, this centrally located city saw its median home price climb from $780,000 in 2018 to over $1.35 million by 2022, a jaw-dropping 73% jump. But in 2025, the correction has begun. Prices have already slid by 7% to 9%, bringing the median back to about $1.23 million, and they're still falling. With mortgage rates stuck around 6.7%, monthly payments on an average Tustin home are now approaching $8,000 after including taxes and insurance. That's an unsustainable burden, even for households earning above $150,000 per year, which is close to the city's median. Inventory is also up sharply. Tustin had just 60 active listings per month in 2021, but that number has ballooned to 150 plus in 2025, with homes taking 45 to 60 days to sell. Over 35% of listings are showing price cuts, some in the $75,000 to $150,000 range. Days of open house bidding wars are long gone. The buyer pool has shrunk significantly. First-time buyers are priced out, and move-up buyers are locked into 3% mortgage rates they're unwilling to give up. Meanwhile, many investors are bailing as rent yields decline. The average rent for a single-family home in Tustin is about $4,200 per month, which doesn't come close to covering the cost of a new mortgage. With home values still sitting 97% above long-term price trends, and with affordability metrics flashing red, experts forecast a potential 15 to 20% decline in the next 12 months. Tustin's price growth was never organic, it was speculative. Now that the speculation is gone, the correction is in full swing. Number 7. Milpetus. Milpetus rode the tech boom like a rocket. This Silicon Valley city, wedged between Fremont and San Jose, saw its median home price jump from $900,000 in 2017 to a staggering $1.58 million by mid-2022, a whopping 75% gain in just 5 years. But in 2025, with tech layoffs rolling through the Bay Area and affordability stretched past the breaking point, Milpetus is on the front lines of a sharp housing correction. Over the past year, median home prices have already dropped by 12%, dipping to around $1.39 million. Inventory has surged from an average of 50 listings in 2022 to over 140 active homes on the market. Nearly 45% of listings are cutting prices, often by $100,000 or more. The problem is twofold. Demand is collapsing while mortgage rates are still high. At 6.75%, a $1.4 million mortgage with 20% down equates to monthly payments of $9,000 to $10,000. The median household income in Milpetus is high, about $145,000, but that still falls short of comfortably affording today's prices. The city's reliance on nearby tech employers is another weakness. As companies like Meta, Google, and Cisco tighten their belts, many prospective buyers are delaying purchases or forced to sell. That's added even more downward pressure to the local market. Rentals offer no safety net. Average rents in Milpetus are around $3,800 per month, which doesn't come close to cash flowing on a new purchase. Investor activity has slowed to a trickle. With prices still nearly 100% above historical price trends and economic uncertainty hanging over the tech sector, analysts predict a potential 20 to 25% further drop through late 2025. For many homeowners, especially recent buyers, that could mean plunging equity or even going underwater. Milpetus is no longer just cooling, it's actively cracking. Number 6. Aliso Viejo. Aliso Viejo, a master-planned community tucked into the rolling hills of southern Orange County, was once the picture of suburban prosperity. Between 2015 and 2022, home values in Aliso Viejo exploded from a median of $680,000 to over $1.15 million, a jump of nearly $600,000, 70%. But in 2025, those gains are rapidly reversing as affordability collapses, inventory climbs, and buyer demand dries up. Today, the median home price in Aliso Viejo has slipped to around $1.05 million, down roughly 9% from peak. It might not sound catastrophic until you factor in the steep drop in buyer activity. Active listings have more than doubled, from 55 homes in 2022 to over 120 in mid-2025, and properties are sitting on the market for an average of 47 days, compared to just 11 days in early 2022. The affordability metrics here are flashing red. With 20% down, a typical buyer would need to finance roughly $840,000, which at a 6.8% mortgage rate leads to monthly payments exceeding $6,900 before taxes, insurance, and HOA fees. That's unaffordable for the average household, even with Aliso Viejo's relatively high median income of about $115,000. Investor appetite has cooled significantly. Rents for single-family homes average $3,900 per month, making cash flow nearly impossible on new purchases. That's leading many landlords to offload their properties, and competition among sellers is forcing dramatic price cuts, some as steep as $150,000. Aliso Viejo's appeal hasn't vanished, but the economic fundamentals don't justify 2022's prices. With values still hovering 86% above historical trend lines, and a growing number of households priced out or unwilling to buy at these levels, a further 15 to 20% price correction seems all but inevitable by late 2025. The crash here is quiet, but it's real. Number 5. Lakinata Flintridge. Lakinata Flintridge is one of Los Angeles County's most prestigious enclaves, boasting tree-lined streets, award-winning schools, and luxury homes that often exceed $3 million. But that prestige comes at a price. And in 2025, that price is falling. The median home price here peaked near $2.95 million in 2022. Today, that's down to around $2.68 million, a drop of 9% with further declines on the horizon. Unlike flashier markets, Lakinata Flintridge doesn't see massive transaction volume. But what it does have is a problem with affordability and overvaluation. Homes here are currently priced about 83% above their long-term trend, and even households earning $300,000 plus annually are struggling to afford new mortgages. With 20% down, a $2.7 million loan at 6.9% interest translates to a monthly payment of $17,500, including taxes and insurance. That's enough to make even affluent buyers think twice. Listings are rising slowly but steadily. In mid-2022, there were barely 25 homes for sale at any given time. Now, that number has climbed past 60, with properties taking 65-plus days to sell. Over 40% of listings are experiencing price cuts, some by $200,000 or more. High-end investors are also exiting. Luxury rentals fetch $7,500 to $9,000 per month, which doesn't begin to offset the mortgage on a newly purchased home. Add in rising wildfire insurance premiums, which have doubled in parts of LA County to over $10,000 per year, and the costs become staggering. Lakinata Flintridge has weathered downturns before, but the 2025 landscape is uniquely challenging. With ultra-high prices, limited demand, and weakening fundamentals, analysts are eyeing a 15 to 25% total decline by year's end. The crash here may not be loud, but it's absolutely elite and painful. Number 4. North Tustin. North Tustin isn't a city but a prestigious unincorporated community in Orange County known for its sprawling estates, privacy, and elite zip codes. But even this coveted corner of Southern California isn't immune to the brutal arithmetic of housing market correction. In 2022, the median home price in North Tustin surged to nearly $1.79 million, up from $950,000 in 2015, an increase of almost 89%. Today, in 2025, that boom is coming undone. Home values have already slipped 8% to 10%, with the current median now hovering around $1.63 million. Inventory, once scarce, is now rising fast. Active listings are up nearly 85% year over year, from 45 in mid-2023 to over 80 in mid-2025. Properties are lingering on the market for 60-plus days, and more than 38% of listings have had price reductions. The affordability crunch is severe. With a 20% down payment, buyers still face a mortgage of roughly $1.3 million. At 6.75%, that's a monthly payment of $10,200+, including taxes and insurance. That far exceeds the financial comfort zone of even households earning $200,000 annually. Even worse, the rental market isn't bailing anyone out. Luxury homes in North Tustin command around $5,000 to $6,000 per month, not nearly enough to support the cost of new ownership. Investors, recognizing the growing mismatch, are backing away. North Tustin also faces demographic pressures. With baby boomers downsizing, many larger homes are flooding the market, but younger buyers can't afford them. That supply-demand imbalance is pushing prices lower, especially for older homes in need of upgrades. Still priced 96% above long-term value trends, North Tustin is facing a harsh reckoning. Real estate analysts expect a total correction of up to 20 to 25% over the next year, as one of Orange County's best-kept secrets becomes one of its most vulnerable markets. Number 3. Cotto Dasa. Cotto Dasa is synonymous with exclusivity. Tucked into the hills of southeast Orange County, this guard-gated community once attracted celebrities, CEOs, and the ultra-wealthy. But in 2025, even high-end enclaves like this aren't immune to market gravity. During the pandemic-era frenzy, median home prices in Cotto Dasa surged from $1.25 million in 2019 to a jaw-dropping $2.05 million by late 2022, a 64% increase in just 3 years. Now, that number has already slipped below $1.85 million, and deeper losses may be coming. Luxury homes that once sold in days now linger on the market for 70-plus days, and active listings have doubled from 45 homes in 2022 to over 90 in mid-2025. Nearly 50% of current listings have price reductions, with some slashed by $200,000 to $400,000. Buyers are hesitant, and the math explains why. With a 20% down payment, the monthly mortgage on a $1.85 million home at 6.9% interest exceeds $12,000, taxes and HOA included. Even for high-income earners, households earning over $300,000 per year, this is a stretch. And Cotto's elevated HOA fees, which often exceed $400 a month, only add to the burden. Rental income offers no safety net either. The average rent in Cotto is around $6,500 per month, far short of mortgage costs, making it unviable for investors. The area's appeal, privacy, golf courses, equestrian trails, is undeniable. But in 2025, rising interest rates, insurance premiums, and stagnant wages are strangling demand. Worse yet, the demographic shift is real. Wealthy boomers are cashing out, but Gen Z and millennials can't afford to buy in. Still priced 93% above its long-term trend, analysts project a further 15 to 25% correction. Cotto Dasa, once a fortress of value, now faces the reality that even gated luxury has its limits. Number 2. Villa Park. Villa Park is a tiny enclave in Orange County, often dubbed the Hidden Jewel for its low-profile prestige and estate-sized properties. With just over 6,000 residents and no apartments or commercial centers, it's one of the wealthiest zip codes in Southern California. But even here, the 2025 housing market correction is proving unavoidable. Median home prices soared from $1.6 million in 2018 to a blistering $2.34 million by mid-2022, marking a 46% surge. In 2025, however, that number is retreating, now down to $2.12 million and likely still falling. Why the retreat? Simple economics. With a 20% down payment, today's buyer needs to finance nearly $1.7 million. At an interest rate of 6.75%, that's a monthly mortgage of over $13,800, including taxes. Even for households earning $400,000 per year, that's pushing the limit. Inventory, once almost non-existent, has doubled. In 2022, there were rarely more than 15 listings at a time. Today, there are 35-plus homes on the market, and over 40% of them have slashed prices, some by $250,000 or more. Homes now sit unsold for an average of 60 to 80 days, compared to just 14 days in the hot market of 2021. Villa Park's unique appeal, quiet streets, oversized lots, top-rated schools, isn't enough to overcome the affordability wall. Rents average around $7,000 per month, which is far below what's needed to support a $2 million mortgage. As a result, investors are fleeing, and end users are simply priced out. Another issue, rising insurance premiums due to wildfire zones, have pushed annual home insurance from $3,000 to over $8,000. For aging boomers, the cost of staying is too high. For new buyers, it's too risky. Villa Park homes remain 89% above historical price trends, and without a sudden economic boost, experts anticipate an additional 15 to 20% drop by the end of 2025. The hidden jewel may be losing its shine. Number 1. Irvine. Irvine has long been considered the poster child for planned perfection in Orange County: great schools, tech campuses, shiny new developments. But in 2025, Irvine is also becoming ground zero for California's housing correction. The median home price here soared from $850,000 in 2017 to a stunning $1.62 million by mid-2022, a nearly 91% increase in just 5 years. Now, the market is buckling under its own weight. As of 2025, the median home price has already dipped to around $1.48 million, and the trend isn't slowing. Listings are piling up. There are now over 450 active homes for sale, nearly double what the market could absorb in 2022. Homes that once sold in under 10 days now take 40 to 60 days or more, and 38% of listings have seen price reductions averaging $100,000 to $200,000. Affordability is at crisis levels. With a 20% down payment, buyers are looking at financing $1.18 million, which at a 6.8% mortgage rate means monthly payments near $10,000, including taxes, HOA fees, and insurance. The average household income in Irvine is about $135,000, which simply can't sustain that. Even Irvine's once explosive rental market is cooling. The average rent for a 3-bedroom home is around $4,500 per month, well below break-even levels for new buyers. Foreign buyers, a major factor in Irvine's boom, have also pulled back due to geopolitical and economic uncertainty. Moreover, the tech sector's slowdown has hit the city hard. With layoffs from nearby Silicon Valley firms and a saturated housing supply, the days of unlimited demand are over. Still priced 111% above its long-term value trend, Irvine is dangerously overextended. Experts forecast a further 20 to 30% correction by the end of 2025. The city that once defined housing success is now a textbook example of what happens when supply, speculation, and rising rates collide.